All right. So my name is Nathan Browning. I am a stealer of content for this presentation on retirement planning. And just a quote from Jack Bogle, who you'll learn about in this presentation, is don't do something, just stand there. So a lot of times we hear, don't just stand there, do something, but the opposite is a lot of the time true for investing, and we'll talk about that. So here's a basic agenda for what we're going to go through. The first is a few disclaimers, because I'm not an expert in this stuff. I'm just a guy that thinks it's interesting and reads a lot about it. So disclaimers, account types and tax implications, some investing strategy, that'll be a big chunk of it, and then how and when to retire. So my first disclaimer is that I'm not an evaluator, or I am an evaluator. I am not a financial advisor, a certified financial planner, a lawyer, a tax expert, and I didn't consult any for this presentation. So you might be questioning why you're even here at this point, and I hope it will be worthwhile. I think I read and optimize investing. It's like a hobby of mine. I'm something I find really interesting, but not everything. This is a huge topic, and not everything can be covered in the 25 or 30 minutes we have. So what I share is just my perspective and opinion based on long-term historical data and tax structures. I'm an evaluator, remember, so that gives me some credibility, but it's primarily American perspective. There is a lot of crossover with other countries, but I'm not super familiar with that. And this is mostly just for entertainment and informational purposes only. I hope you get to learn something. The second disclaimer is that all investment strategies and investments involve a risk of loss. Okay, so I'll be referencing an investment's past or potential performance. It's not a recommendation or a guarantee of any specific outcome or profit. This is just, no one can see the future, essentially. And also, investing is a highly personal topic, right? So information conveyed in here may not be appropriate for you given your risk tolerance. And I've tried to sort of take back any generalized, advice for that reason. If you want personalized advice, seek an appropriate expert. So you might need a tax expert. You might need a financial planner that's fee-based and not percentage-based. You might need an estate lawyer. So just think about your situation and who might be the smartest person to contact for that. So just a little bit of insight to this as a broad view. Only 1 in 4 Americans, or 1 in 4 Americans have no retirement savings at all, so 0. And then those who do aren't saving enough from Yahoo Money. And so I wanted to do a little experiment here. This is a little risky because it's totally anonymous, okay? But I'm curious how much people here have saved for retirement, okay? And I based these buckets on that Yahoo News survey that they did, and use the same buckets as well. So go ahead and join the poll everywhere in whatever way makes the most sense to you. And I'll give a couple minutes so we can see how we're doing among our peers, our evaluation and independent consultant peers.
How do we get to the poll?
So the instructions are at the top. You can use your phone number to text, or you can use your phone to text 2233, and you text Nathan Brownie 981, it looks like. And then there's also an online version that you can join in the top there. I can't actually see it because my Zoom bar is covering it.
Can you put the link in the chat, please? Oh, there it is.
Beautiful. Thank you to whoever did that. I'm trying to fill this out too. So here we go. All right. A lot of people have quite a bit saved for retirement. Looking at the buckets, based on the national survey, this is pretty good. No one said 0 so far. That's really good news. Or maybe they're just embarrassed, but that's okay. You would be with 25% of Americans in that case. All right, great. So that's really insightful. I'm going to go ahead and go on. The first thing we're talking about is retirement accounts. This is probably the most boring part, so if you tune out, I don't blame you. But retirement accounts are just a place where your investments live, and there are a few different kinds. Employer-based accounts like the 401k and the 403b, which is the nonprofit equivalent. There are two different really tax types you can use. The first is traditional. Traditional 401k lowers your tax obligation now, it lowers your taxable income, and it defers it to when you liquidate the funds. And when you liquidate funds upon retirement, it's taxed as ordinary income. Then there's a Roth option, and the Roth option will tax you in full now when you contribute to it, but you don't have to pay any taxes on it in the future at all, which is really, really powerful. And it's a great option to have available. And it might not even make sense. It might be actually preferable for you to do traditional, but combined for a 401k and 403b, you have a contribution limit of up to 20,500. And if you're over 50, you can actually contribute a little more. They call this the catch-up contribution. So for personal accounts, those are both employer-based. So you'll have to have an employer. You can do it as an independent consultant, which I'll talk about. There's IRAs. And so there's traditional and Roth available as well. They work the same way as the ones for 401k and 403b. For Roth IRAs, there's an income limit. So if you make over $144,000 modified adjusted gross income, whatever that means, ask your CPA, then you cannot contribute to a Roth, although there's some backdoor ways to do it that are way too complicated for me to cover here. And there's a combined contribution limit for Roth and traditional of 6,000 and 7,000 if you're over 50. And then there are just straight up brokerage accounts. They are taxed now and they are taxed later. And they also get capital gains taxed. So there's a lot of different tax that goes into those ones, and generally not preferred, but if you reach your limits, then that's probably the next best way to invest. So for independent consultants, there's an account called the solo 401k. And this is for self-employed people that have no employees. And then like the definition of who an employee is kind of loose. Like if you have an intern over the summer, but otherwise it's just you or your spouse, then you're good. So there's specific rules about it that you'd have to look into for part-time employees and that kind of thing. But as an employee, you can contribute the same as a W-2 employee could contribute to a 401k, which is 20,500, and then the same 27K over 50. But you're also an employer, and as an employer, you can contribute up to an additional $40,000 or so in profit sharing. The amount you can actually do depends on your income. I don't remember exactly what the calculation is. I believe it's something like 25% of your profits, but don't quote me on that. So that would be the upper limit. And then you can contribute to Roth or traditional, but if you're using that employer contribution, it has to be traditional. It cannot be a Roth. There's another interesting option for independent consultants or for people with small firms specifically, with or without employees, which is called the SEP IRA. And it's called an IRA, but I believe it's more along the lines of 401k. And so each person that is part of this plan, the SEP IRA, can contribute 25% of their compensation or up to $61,000, whichever is lower. And these are all pre-tax, so there's no Roth option. And if you include this plan, every compensated worker for your firm has to be included and informed of the plan. And so if you do this in tandem with a solo 401k, it shares a contribution limit. So like the practical advice about Roth versus traditional, it's not an exact science. I hope you're all pretty comfortable with that feeling as an evaluator. But in general, if you think that when you retire, you're going to be in a higher income tax bracket, then the Roth option now might be the better choice. But if not, then traditional is probably the way to go. Okay, so that's the accounts. That's the boring stuff. Now it's time for the interesting stuff, that I think at least, about investing. So the best, you hear this probably, best time to plant a tree or invest was 20 years ago, and the next best time is today. Okay, so this is just an example of how starting 10 years earlier can make a huge difference, mostly through compounding interest, right? We have someone who starts at 25 versus someone who starts at 35 versus someone who starts at 45. And just how big the difference is, that your money starts working for you the earlier you invest. So just something to keep in mind that if this is something that you haven't prioritized, now it's the great time to do it. And how do you invest? Okay, so deciding what vehicle, like that 401k, the Roth, the IRA, whatever combination you go with, is honestly the hard part. From my perspective, the investing itself is pretty straightforward. And I think the Boglehead's approach, which is named after Vanguard founder Jack Bogle, who is quoted at the beginning of this presentation, is really the most straightforward and simple approach for the common person. So once you open an account, which you can do at Vanguard, Fidelity, Schwab, E-Trade, I'm not going to talk about which ones are the best, but we can afterwards. You can begin to invest, and you can open a lot of different kinds of accounts. You can open a 401k at Vanguard, a solo 401k, an IRA, a brokerage account, so on and so forth. And basically, the Boglehead's approach has three major tenets. The first is don't put all your eggs in one basket. The second is minimize fees. And the third is that time in the market beats timing the market or stay the course. So first, diversification. There's a couple ways to diversify. The first I'll talk about is having many companies, okay? So Jack Bogle was the creator of this sort of index investing strategy. Essentially, he created a mutual fund that investors could buy that tracked the top 500 companies in the US. And today you can actually get funds that contain over 9,000 companies. And Vanguard, the company, specializes in creating those. And so my favorite fund, for example, is called the Vanguard Total World Fund. And it's also noted as VT or VT Wax. And it has over 9,000 companies that are in it from all over the world. And diversification in that way is really important because if you invest all of your money into one company, it can fail for many reasons, right? Like the company, maybe not even in their control. Some external force might, the government or environmental might come and affect the company in a major way, but it's not very likely for that to happen to over 9,000 companies all at once. So that's why diversification of companies is important. There's also diversification of asset classes. So depending on your risk tolerance, which is often a function of your age, you'll probably want a mix of stocks and bonds. And a common calculation is like to subtract your age from 120. And the resulting number that you get is the percentage of your retirement that should be invested in bonds. And essentially, Vanguard also creates these diversified bond funds that have bonds from many different governments, many different corporations. But a lot of people are comfortable using US Treasury bills. And I put some examples of those two types of funds for their bonds. And bonds are important because they're typically a little more stable. For those that don't know, they don't have as much volatility as stocks. So, if there's big fluctuations in the stock market, like we saw with COVID, then your bonds will sort of keep your total investment amount more steady. And that's more important as you age because you're actually going to start drawing from that. And it's important to be able to predict. And there are funds called target date funds that automatically shift your allocation based on your desired retirement year. It's totally simple, like set it, forget. These are some of the best things that we have, some of the best financial instruments that we have. So if you don't use one of those target date funds, you're probably going to have to rebalance your bond percentage on a scheduled basis. There's not like a perfect way, it's basically your preference, but quarterly, twice a year, or once a year would be fine. And because sometimes stocks will outperform, sometimes bonds will outperform. So if you want to maintain your sort of targeted allocation, you'll have to rebalance. Like if stocks have a really good year, you have to sell some and buy back some bonds. So that way you maintain sort of your risk portfolio or your risk profile that you're wanting to keep. So the second tenet is minimizing fees and avoiding active management as well. So in mutual funds, you'll typically see an annual percentage fee that gets charged. They call it an expense ratio, but they can range from fractions of a percent, like 0.04%, all the way up to 2 to 3%, or even higher. But typically you see it around that 2 to 3% or less. And Bogle called this dilemma the tyranny of compounding costs. And basically what happens is even like really tiny increases in expense ratio eat away at your retirement nest egg in a compounding way. So when you look at high fee funds, they're typically actively managed, which means there's like a person that's watching over them and making trades and things in real time. And that might feel good to know that someone's like watching over your money actively, but the data actually bears out that a passive approach yields better returns on average. So here's an example of how fees affect an investment balance. So we have $10,000 invested over a 40-year timeline. And the assumption is some level of growth per year that compounds. And so if we look at a 0.04% expense ratio, which is about the lowest you'll find on the market, you'll end up with around $70,000, $69,000 after 40 years. And you'll pay $500 in fees. And then the drag, which is sort of the opportunity cost of those fees being in place, would be around $1,100. So overall, $1,600 lost over a 40-year timeline. So now we look at a graph of a 2% expense ratio. This doesn't sound like a lot. 2% seems pretty reasonable. But the ending balance goes from $69,000 to $31,000. Over the course of this, you pay $15,000 in fees, which also compounds because in year 40, you're going to pay 2% of your $31,000 rather than 2% of your $10,000. And then the drag of opportunity cost, of course, compounds as well. So you end up losing out on a huge amount of money over the long term by not paying attention to fees. So those are fees. And kind of related to that active management piece is that time in the market meets timing the market. As evaluators in the social sciences, we know that nothing is 100% certain, but I've put a picture of the S&P 500 graph over its inception. You can see the very first sort of gray bar. That's the Great Depression. And so even like this horrible thing, economic time for our country, you can barely even notice you can kind of see the drop on the graph, but it's very, very small. And over time, it goes up a lot. And we've had a very, very high performance in the S&P 500 in the past few years. So it's not necessarily saying that that's going to not continue or that it will continue. It's just following the trends of the past in this exponential growth. And if you like log scale, then here's the log scale. It's pretty much a straight vertical line. Textbook exponential function being shown here, exponential increase. So essentially, given a long enough time horizon, it's pretty likely that a diversified low fee investment will bring a return of people estimate like 6 to 7% per year after inflation. But if you want to be conservative, you can use 4 to 5%, but not without some volatility because it changes, from year to year. In the short term, especially, the stock market is notoriously unpredictable. And so active managers of mutual funds, for that reason, tend to underperform passive investors. There's a cool bet that Warren Buffett did with active managers. He basically bet them, like, if any of you can beat the index, I'll give you $1 million or something. And I don't think anyone ever did. So if you time the market, selling in a crash or even waiting to buy until there's a dip in the market, it's honestly the #1 pitfall of most investors. And when your investment falls a lot in a short amount of time, it can be pretty stressful and fearful, maybe losing work as well. So, there are times where you have to liquidate to, support your family or, get groceries on the table. But if you're intentionally like following the markets and really trying to time it and make sure you're, buying things quickly, it can really dismantle your overall plan. So to demonstrate this, a tale of 3 investors. So the first is Tiffany. She has terrible timing. She saves $200 a month in cash and then only invests in lump sums at the very, very top of the market right before a crash. But then she doesn't sell after that. She invests $99,000. Then there's Brittany. Brittany is omniscient and knows exactly when the absolute lowest stock price is going to be. She saves $200 a month in cash and then she purchases it at the lowest and she doesn't sell after that. Invests $99,000. And then there's Sarah, who's an average person. She sets up an auto invest of $200 a month and never looks at the account again. And she has $99,000 invested as well. And this is stolen from the source below. And here's the photo of how the 3 perform over a timeline. So Tiffany, who had horrible timing and always bought at the very top, despite only investing $99,000, she still ends up with like $750,000 because she never sold. She bought and she never sold. And then there's Brittany, who had perfect timing. She waited for every single low in stocks that there was, and then she put all of her money in and perfectly timed the market. And she turns her $99,000 into like 1.2 million or so. And then there's Sarah, who didn't try to time anything. She just took a hands-off approach, invested $200 per month, auto invest. And through all the ups and the downs, she actually ends up with the most. And the reason she ends up with the most is because there are a lot of times in the stock market where it goes up and it doesn't go down. And when it does go down, it's not as far down as it was at the previous low. So when Brittany was waiting for that crash, Brittany was losing out on gains that were happening, whereas Sarah was buying out throughout the whole time. So timing the market beats timing the market. That's simple, and it's easy. It's easy too. It's the easiest way to invest. I want to talk about ESG funds. For this group in particular, they're called environmental, social, and governance. And essentially they contain select companies that meet ESG criteria. And it's essentially putting your money where your values are. It's also called like sustainable investing, responsible investing, impact, green, socially responsible investing. And it's an admirable approach, but I'm going to give you some reasons why this might not be the best choice. The first reason is because the people who decide what go into these ESG funds are investment managers. They have criteria. They're not always very transparent what the criteria are for what type of companies get to be included in an ESG fund. So it's not a universally agreed upon definition. They might differ from what your values are. For example, Vanguard, who I've been like promoting this whole presentation, their flagship US ESG fund includes Facebook. And we know Facebook has a lot of problematic issues like with the election type of tampering and advertising and like children and all those sorts of different things. So your values might not align with what an ESG fund says. Another reason is ESG funds have higher expense ratios typically. Vanguard does offer lower alternatives, but as I mentioned, even their ESG funds might not match your values. And then the third is because ESG fund removes companies, it actually decreases the diversity. And so it increases risk. So if you're removing, so I'll give you an example, like in Vanguard's 1,400, so ESG companies, Vanguard's total US stock market fund has like 7,000 companies. So you're removing a lot. And in those 1,400 ESG companies, the top 10 stocks are typically tech stocks, and they make up 30% of the fund's performance. So you're actually putting a lot of your risk into these top 10 tech-related stocks. So it decreases diversity. A few other reasons. If you divest from bad companies, you lose voting power, and you also lose influence to guide that company in environmentally sustainable or socially responsible ways. So for example, there's a climate activist group called Engine Number One. And essentially they pulled together enough money to purchase enough Exxon shares to get 3 board members onto the Exxon board of directors. And so it might even be a better approach to try and get shares in a company to be able to influence the direction of that company in the future. There was a former BlackRock chief investment officer that had a quote that I thought was insightful. They said, if you really care about social changes, invest your portfolio as you've always done, which is to get the best returns and preserve your savings, and then turn to the government and push political action around solving climate change, because that's the only level where it can actually be solved. So someone that has a stake in this or had a stake in this saying, don't do ESG funds, they're just enriching us, actually push for lobbying and political influence around climate change. That'll actually solve it. And then if you really need proof in the pudding, the last point is a study that shows that companies with higher ESG scores tend to have lower expected returns. So there is a financial trade-off that you have to consider too. So those are just some things to be skeptical. You might still want to do ESG funds if you don't want to be invested in certain types of industries. More power to you. I just want to make sure you have a lot of the information up front. And I think it would be something in nonprofit adjacent industry like ours that people would be interested in. So now we get into the final stretch, how and when to retire. And this is maybe the most personal decision of anything I've talked about so far. So I'll just give you some things to consider. If you want your investment to return indefinitely, one rule you can follow is to have 25 times your annual expenses in investments. And that's called the 4% safe withdrawal rule. That excludes any like pensions or social security or anything that's like a guaranteed income. That's based on a a study called the Trinity study that you can look into. And it's not perfect, it's an estimate, and it uses historical data. And there are some calculators I'll link to that will help you as well. But you have guaranteed cash flow like a pension or social security income. That also factors how much you need in investment. So that 25 times might be too much or too little or however much. But ultimately your age, your spending, and your cost of living, your quality of living, your desired expenses, your desire to leave behind an estate, your health, and there's a bunch of other factors that go into the decision of when to retire. And so you can use a retirement calculator to kind of figure out that approximate age that you would be able to comfortably retire. I linked one here that's pretty simple. I put this presentation in the chat so you can actually click it. And I can link these afterwards as too, and I'll make sure that the slides get shared out. But essentially the hardest piece of information to predict, I think, in retirement is expenses. And again, I'm 26. Okay, so you can say, okay, this kid can say whatever he wants. So this is definitely the least informed place I am about this kind of thing. But essentially, this calculator that I linked will assume that your expenses are going to be the same as they are now. And so you might want to spend more in retirement. You might be able to cut back in retirement. So there are other calculators where you can do that. And I linked one at the end of the presentation. Some other things to consider. So if you're not using a target date fund, you can consider building a bond tent for your immediate after retirement spending. And this is in order to protect against sequence of return risks. And so essentially, like, what happens if the year you decide to retire, there's a big recession? If you have 100% stocks and there's a big recession, you might see your total investment value go down by like 20%. And if you sell those stocks when they're low, it'll have an effect on how much you'll be able to increase that in the future. But if you instead sell bonds, that's what the bond tent is essentially you're building a safeguard of bonds when you retire that you sell from instead of selling your stocks, because stocks typically will outperform bonds in the long term. And if you sell those bonds, then you protect your stocks and let them grow and sort of preserve your overall nest egg rather than having to sell the stocks when they're low. So that's one thing to keep in mind. There's also retirement accounts. I mean, almost all of them have an age where you have to start taking distributions, so pay attention to that. I think the age is around 72. So make sure you're paying attention to that. And again, projecting expenses can be really difficult. We don't know about the future. So overestimate, be conservative with that, and have a cushion. You can consider things like long-term care insurance as well that are big financial drains in retirement, or you can try and build room for budget flexibility. And so just saying a few words in closing, as really nonprofit adjacent independent consultants, we have pretty special privilege to do what we love to do, better the world, and get paid to do it. And so the idea of retirement might seem pretty far-fetched, far away, or not really like you if you want to keep working. But just remember that retirement just means doing exactly what you want to be doing with the time that you have gifted to you. So that might mean going solo and working only part-time, or developing research papers and conference presentations to present at AEA, which, by the way, the deadline is coming up. I think it's the 22nd. So get your conference proposals in, or you can play pickleball. So whatever you want to do, that's up to you. Just retirement is just having the financial freedom to be able to choose what you want to do. And that's all I have. I know that was a lot. So I'm looking forward to opening up the discussion and hearing what you all have to say. Thank you.